Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Richard Power of Octopus Investments to talk about the Octopus AIM Inheritance Tax Service. Hello, Richard. Welcome.
Hi, Jonathan.
Welcome back to the studio. Firstly, for those who aren't familiar, could you give us some background to Octopus Investments and your own experience?
Yes, certainly. Octopus was founded in 2000, and it started off by specialising in tax-driven products. So we're one of the market leaders across the venture capital trust market and the business relief market, which we're here to talk about today. It's got various specialisms, one of which is quoted smaller companies, but also ventures, property, and renewable investing.
And your own experience?
I've been at Octopus since 2004, and we launched the AIM Inheritance Tax Service a year later in 2005. So we've been running that for over 17 years now. Now that's been very helpful because we've had the experience of running this particular mandate through various cycles, through the financial crisis and through the COVID disruption, and of course through the market headwinds that we've been experiencing over the last 18 months, 2 years or so.
So Richard, we're here today to talk about the AIM Inheritance Tax Service. What does it aim to do for investors?
Well, we create a portfolio of AIM-quoted companies that have two objectives, really. First is to deliver capital growth, so we're looking for businesses with that long growth runway ahead of them, but also that qualify for business relief, which enables the client's investments to fall outside of their estate for inheritance tax purposes after 2 years of holding. So that's very attractive for a range of investors who have built up excess capital, particularly in pools of money like ISA portfolios or indeed their mainstream funds.
And what types of companies are you looking to invest in?
Well, we look for companies with specific characteristics. We're very conscious that our clients have built up their wealth over their lifetime, and they are investing in what is deemed to be a higher risk and potentially more volatile asset class. So we're looking for companies that are, of course, profitable, they're cash generative, they have a robust capital structure, so not too much debt, and that's obviously very important in the interest rate cycle we're in at the moment. But also other characteristics like high levels of recurring revenue. They're less likely to disappoint on the market if most of their revenues are repeat in nature. And we like companies that have a niche or proprietary product or service. Again, if companies are global leaders in what they do, they're going to be attractive and valuable to a much wider range of potential investors other than just stock market investors, so potentially private equity or trade buyers. So that's the sort of filtering process that we go through to ensure that these companies are going to be right over the medium term for this particular client base.
And are there any particular types of companies or sectors that you exclude from the portfolio?
Well, we do need to exclude certain sectors that won't qualify for business relief. Not all AIM-quoted companies will qualify for that. So we do get PwC to go through a process of assessing the qualification for us. Certainly companies in the oil and gas and mining sectors where exploration assets are deemed to be property assets, they won't qualify, and therefore there's nothing in those sectors. And again, the property sector doesn't qualify for business relief, so that would be excluded. That's not a bad thing. These tend to be slightly more cyclical and volatile sectors anyway, so it's not a bad thing that we need to exclude those. You also need to look at a number of other aspects, like companies that might have a dual listing on a recognised exchange. They won't qualify, but also some joint venture income as well may put into question the qualification of a particular company.
Okay, but other than BPR reasons, no exclusions on companies?
No exclusions, no. We're open-minded, and we've got a team of 9 investment professionals who are focused on these portfolios, so we've got a broad team looking across the market cap spectrum of AIM as well.
So Richard, could you give us some examples of recent investments you've made in the portfolio?
Yes, we've made a few additions over the last few years, one of which is Ergomed. Ergomed provides services to the pharmaceutical sector across oncology and rare diseases specifically. It's a company we first invested in when it IPO'd on AIM about 10 years ago through our venture capital trust. So it's a business we've got to know very well, and it's built up very successfully a strong position in the European market, and the potential to attract more business over in America gives it that long growth runway ahead of it, which is why we've now included it into the BPR portfolios about 12 months ago. Another example is Marlowe, which is a testing business It also does a lot of governance software provision, and again, high levels of recurring revenue, some of the characteristics that we're looking for.
When you say testing business, what does it do?
It goes out and does a lot of testing, gas testing and things for landlords. It's one division, and then they've got a software division which does governance software for large organisations, which again is nice, as I say, nice recurring revenue.
Fairly non-cyclical business.
That's again what we're looking for. Now, there's always a degree of cyclicality with all businesses. They're all going to be exposed to economic cycles. But what we're hoping to is find businesses that can continue to grow, even though there may well be economic headwinds akin to the ones we're experiencing at the moment. And again, that's where the experience of running these portfolios for a long time comes in. Rather than needing to sell out of companies that do have an exciting future because of short-term headwinds, we want to hold companies through those periods and only sell companies when we think the investment case has fundamentally changed and doesn't stack up as it did when we first made that investment decision.
So sticking with the theme of investment examples, if we look at some of the more mature holdings within your portfolio that you've held for quite a while, do you have any examples there?
Well, we've got we've got a number of examples actually of companies that we put in the portfolios when we first launched it in 2005. So they really have been long-term stalwarts in the portfolio. One of those would be RWS Holdings, which is an engineering services business. It specialises in certain sectors, including rail, highways, nuclear. So essential maintenance for essential infrastructure services, and that's meant it's had a very, very reliable growth profile over a long period of time, and so that's done us extremely well in the portfolios. Another example that's been in since the start is a company called RWS Holdings. They started off as a specialist translator of technical patents, but over the years they've made acquisitions that's broadened out their activities to localisation services and more widely and technology translation services as well. So it's again grown substantially since we first invested. I think it had a profit of about £5 million back in 2005, and they're going to be close to £170 million this year. So again, global leading business on a great growth trajectory, with a great growth runway ahead of them into the future as well.
So turning to the AIM market itself, recent years it's been really quite challenging, as I'm sure you're aware. How's that affecting your portfolio at present?
Well, we tend not to let short-term noise affect the longer-term opportunity. So we're very focused on the underlying businesses, the fact that they're continuing to grow their profits and their ability to grow their profits, because if they're doing that, they are creating value for our underlying investors. So that's what all of our focus is on. Now, share prices have been dislocated from underlying profit growth over the last 18 months. As you say, it's been a very challenging time for risk assets. We've seen a lot of money flow out of this end of the market and out of UK equities generally, which means they're trading on multiples that we haven't seen for many, many years, in a lot of cases since the financial crisis. The underlying businesses themselves, as I say, growing profits and dividends are meeting our expectations. So it has been frustrating. I think I was sitting here a year ago with an equal level of frustration. And at that time, we were looking ahead, expecting recessionary pressure in Q1 of this year that never materialised. And it's not dissimilar feeling today. We're sitting here expecting recessionary pressures into 2024. So there has been this prolonged period of uncertainty, which has meant share prices have remained depressed. But as I say, the companies themselves are performing in line with our expectations.
So what do you think the catalyst is for this to turn around? So underlying performance feels pretty strong.
It's a very good question. There's an enormous amount of frustration for the companies themselves, and of course an enormous amount of frustration for our underlying clients who see a share price as halved in value. The easy conclusion to come to is that there's something fundamentally going wrong with those businesses. In fact, they're doing really very well. It's at start of reporting season in September, and so I've had the opportunity to sit down with a number of management teams across the portfolio in the last week or two. And we're seeing companies continuing to upgrade profit forecasts. And again, they're asking that question, what's going to be the catalyst to shift sentiment and for us to start to see money inflows back into this sector, because that's what it's going to require. Asset allocators allocating back into the UK and back into smaller companies, and that's about confidence. What we need to see is that the interest rate cycle has peaked and probably some visibility of that starting to come down. That's likely to happen towards the end of this year into next year, we think. Then that will start for confidence to return. And then I think we'll see the markets recover quite quickly at that point.
Are you seeing any green shoots? Is private equity starting to come in and take out cheap companies in AIM?
We're seeing quite a lot of M&A activity, which is, from our point of view, quite frustrating. We want companies to grow on AIM over the longer term. But it's shining a light on the very low valuations that exist across the market at the moment, because the premiums that private equity or indeed trade buyers are paying is quite substantial. And in recent years, we saw a healthcare software company called EMIS be taken over by a US trade buyer. More recently, Curtis Banks, again, gone to a trade buyer earlier this year. So we are seeing M&A across the portfolio.
And so the high interest rate environment and the high inflationary outlook, does that change the way you invest at all?
It hasn't meant we've needed to make substantial changes. One of the things I highlighted earlier was we wanted to make sure companies had a good capital structure at point of investment, which means they've got a sensible balance sheet. Now, there will be points where companies do increase their gearing, but we want to be able to see that they can pay that down really quite quickly, within 12, 18 months or so, back to minimal levels. If you look at the portfolio at the moment, the majority of companies have net cash available to them on their balance sheet, which gives them optionality. A lot are still carrying on doing earnings-enhancing acquisitions, or on the front foot and growing. And we've seen that pick up in the last 6 months as well. I can think of 5 or 6 companies who have been out there doing, in some cases, quite substantial earnings-enhancing acquisitions, which is great to see. And companies are still raising money in the market as well. I think there's an assumption that things have gone very quiet and markets aren't open for business, but companies across the portfolio like Midwich, which is a European leading AV distributor, raised £50 million a month or so ago in order to do a Canadian acquisition, and YouGov, probably a brand familiar with a lot of people. Yeah. Absolutely. Again, they raised £50 million earlier in the summer to do quite a transformational acquisition in Europe. So that's great to see, and it's these companies progressing, creating value, and again, this will be reflected in share prices once confidence improves.
So perhaps some green shoots there. What are you finding most challenging about this environment? Is it the fact that, okay, there might be some green shoots of activity, but really there seems to be no re-rating in sight, sentiment seems pretty weak. What are you finding most challenging?
I think what's been challenging is the duration of this downturn, and it has gone on for a very long time. Usually market cycles would have turned by now and we'd be on the recovery, and that would have put people's concerns at ease. And it's frustrating for the management teams of our investee companies, some of whom would like to use their paper and aren't particularly keen to do so at current levels. But more importantly, it's concerning for our underlying investors. And that's the most important thing, that we get the message across that there isn't something fundamentally going wrong with the businesses in which they're invested. It's purely a stock market cycle and sentiment driven share prices. They are naturally going to be concerned when they see the sort of moves that we've seen across AIM, and the AIM index has pulled back circa 40% since its peak in Q4 2021. So that's a challenging thing, is just to make sure that investors aren't worrying unnecessarily about the current malaise in share prices.
So when would you decide to sell a stock? If a company operating performance might be fine, but the stock price just isn't moving, is there a particular point where you say, actually, let's move on to a new opportunity?
Well, if an unforeseen event strikes a business, the first thing that happens is you're likely to see quite a substantial share price fall, on a profits warning, a big contract lost. And that's the point at which we do most work with businesses, to really get involved and understand what the recovery looks like in this business. And is this just a short-term blip, or has this fundamentally damaged the investment case, the longer-term investment case for a business? We like to consider ourselves long-term co-owners of these companies, and we'll be quite patient as a company gets back on a recovery and hopefully back to record profits again. And we've seen that happen with a number of our holdings, where we have been patient and we've seen them come back to sort of previous highs again. If we think the investment case has deteriorated, or the competitive landscape has shifted against them, or the regulatory environment has shifted against them, which is going to impede them longer term, that's a time which we will sell a holding. Or if the capital structure looks in a very precarious position, and we've lost confidence in the leadership team to be able to steer the company back into sort of calmer waters.
So we've spoken about the challenges investing in AIM. Opportunities. Where are you seeing the best opportunities?
Well, we're seeing substantial opportunities at the moment. As I think I've explained the frustration of seeing companies that are continuing to grow really very successfully, but seeing their share prices at half the rating that they've been on over the last 10 years or so. And it's a great entry point for investors into the AIM market at this point. One of the companies we met last week is a business called Gamma Communications, which does business-to-business communications. It's called Unified Communications as a Service. So it's, again, recurring revenues. They just had their interim results. Again, another earnings upgrade. They're growing top line and bottom line by circa 10%. They've got 125 million of net cash on their balance sheets in order to do additional earnings enhancing acquisitions. So everything is going very well for them, yet their share price is less than half of where it was 18 months ago. And that's the frustration. But it is an opportunity for investors at this time in the cycle. And we have every confidence that share prices will recover back towards back above levels that they have been at previous highs as they get back towards previous ratings. And we saw exactly the same through the financial crisis, and we can draw very similar charts now mapping the growth in profitability with the decline in the share price and that store of value that has opened up in the market, very similar to when it did back in the financial crisis.
So you mentioned earlier AIM has fallen by roughly 40%. Investing in AIM today, what are the key risks? Can it fall another 40%?
Well, there are always risks in investing in small companies, and small companies can be more volatile than larger companies, and small companies can be less liquid than large companies, and those are the key risks for investors to consider. We consider those risks in the type of businesses that we invest in, and we touched on some of the characteristics earlier. We want the larger, more established, more profitable, robust businesses that are global leaders, and again, that's to try and ensure that we have liquidity, but also reduce the volatility. It's been quite a different experience during the recent downturn to the financial crisis. It tended to be the more globally facing growth-orientated businesses that we've seen the greater de-rating on, rather than some of the more domestically based businesses. And if you go back to the financial crisis, it was the other way around. So if I use the Renew and RWS analogy, Renew had a much more volatile journey through the financial crisis than global facing RWS. This time around, it's been the other way around, where Renew's probably only 15% off its share price high, whereas RWS probably near 70% off its high. So it has been a different dynamic. I think it's just where we've seen the liquidity. We've seen more international investors come into AIM over recent years, and we've seen that selling pressure on certain types of businesses. But it's been very frustrating. Maybe? There's an element of currency tailwind running into the recent downturn and has shifted into being a bit of a headwind. And you've had some other little headwinds as well around UK corporation tax a little bit higher. You mentioned currency. Those companies that do have a little bit of debt, their interest charges are biting. So you are having a little bit of headwinds in certain places. But that doesn't detract from the longer term growth runway that these businesses have in front of them, which is why, again, we're confident that once we look through this period of uncertainty, we'll see ratings recover to previous levels in due course.
So finally, to sum up then, Richard, for investors looking to invest in a AIM IHT portfolio this year, why should they invest in the Octopus AIM IHT portfolio?
Well, we've got a lot of experience in this market. We've got a very big team focused on the AIM market, but not just the larger companies on AIM, but also the very early stage companies on AIM. So being able to invest in them, having been co-owners of these companies for many years prior, helps to de-risk the portfolio for us. We think it's a great time in the cycle to be investing at the moment. It's very important to strip away some of the short-term noise and look at the longer-term prospects for these businesses, and indeed the entry point in which we're getting in today, i.e. the earnings multiples that we're paying today, then we think there's a very compelling case for those investors that are taking that 5-year time horizon, which of course inheritance tax investors are.
Very interesting. Richard Power of Octopus Investments, thank you very much.
Thank you very much, Jonathan.
If you are watching on YouTube, please press like and subscribe to the channel for more.